Let me tell you what happened at a closed-door meeting in Basel, Switzerland, 14 months ago. Not a public meeting, not a press conference, not the kind of gathering that gets covered by financial journalists or discussed on CNBC. A private meeting, the kind where the people who actually run the global monetary system sit in a room without cameras and say the things they will never say publicly. I was not in that room, but I know people who were. And what came out of that room, filtered through conversations I have had over the past year with people whose judgment I trust completely, is the single most important piece of information that any person with savings, investments, or a retirement account needs to understand right now. The message was simple. The current global monetary system, the system built on American dollar dominance, on U.S. Treasury bonds as the world's reserve asset, on the post-1971 framework of floating fiat currencies managed by central banks, that system is in the final stages of a transition that has been building for over a decade. The transition is not hypothetical. It is not a future risk. It has already begun. And the decisions that ordinary investors make in the next 12 to 18 months will determine which side of the largest wealth transfer in modern financial history they end up on. I have been in markets for over 40 years. I ran Dowson Capital for 30 years. I generated an average annual return of 30% without a single down year. Not one. I managed money for George Soros. I was the architect of the trade that broke the Bank of England and returned over $1 billion in a single day. I have lived through 6 major financial crises and come out the other side each time, not just intact, but significantly wealthier. I do not say any of that to impress you. I say it because what I am about to tell you is not speculation. It is not a conspiracy theory. It's not the kind of breathless prediction that fills YouTube channels and financial newsletters during periods of market anxiety. It is pattern recognition built across 4 decades of watching monetary systems strain, bend, and ultimately break under the weight of their own internal contradictions. And what I am seeing right now in the data, in the capital flows, in the decisions being made by central banks and sovereign governments around the world is the clearest signal I have ever observed that a global monetary reset is not approaching. It has already started. The question is not whether this happens. The question is whether you are positioned on the right side of it when the transition accelerates from a slow and largely invisible process into something that moves fast enough to shock the majority of investors who have not been paying attention to the right signals. Let me start at the beginning, because the reset we are experiencing did not start in 2024 or 2025. It started in 2008 and has been building momentum ever since. Understanding the origin is essential to understanding the opportunity. In August 1971, Richard Nixon closed the gold window. He ended the convertibility of US dollars into gold and terminated the Bretton Woods system that had governed global monetary arrangements since 1944. What replaced it was something entirely new in monetary history, a global reserve currency, the US dollar, backed by nothing except the full faith and credit of the United States government, and the geopolitical power that enforced dollar dominance in global trade. For 50 years, that system worked remarkably well. American consumers got cheap imports. Oil-producing nations got dollar revenues that they recycled into U.S. Treasury bonds. Asian manufacturing nations got access to American markets. The world got a stable reserve currency and a reliable system for settling international trade. And the United States got the extraordinary privilege of being able to borrow in its own currency at rates subsidized by global demand for dollar assets. That system has been straining at its foundation since 2008, and in the past 3 years, the strain has reached the point where the fractures are no longer invisible. Here is what has changed and why it matters for every dollar you own. The United States has abused its reserve currency privilege to a degree that is now forcing the rest of the world to seek alternatives. The U.S. government currently carries $36 trillion in debt. The annual interest payment on that debt runs at approximately $1.1 trillion per year, which is larger than the entire defense budget. The Congressional Budget Office projects that within 10 years, interest payments alone could consume 40 cents of every dollar the federal government collects in taxes. The deficit is structural. It is not going away. It is getting larger. When a country with a normal currency runs deficits of this magnitude, the bond market forces discipline. Interest rates rise to the point where borrowing becomes painful enough to change behavior. But the United States has had a unique protection against that discipline. Global demand for dollar assets, foreign governments, sovereign wealth funds, and international institutions buying U.S. Treasury bonds not because of yield, but because they need dollars to conduct international trade and hold as reserve assets. That protection is eroding. China has reduced its U.S. Treasury holdings from over $1.3 trillion at peak to under $800 billion today. Russia effectively left the dollar system entirely after 2022 sanctions froze its dollar reserves, a decision that sent a signal to every other government in the world about the political risks of holding dollar assets. Saudi Arabia has begun settling oil trades in currencies other than the US dollar for the first time in 50 years. The BRICS nations, representing nearly half of the world's population and a rapidly increasing share of global economic output, are actively building alternative payment systems and discussing reserve assets that are not tied to American monetary policy decisions. This is not a fringe development. This is not anti-American sentiment disguised as economics. This is rational self-interest by governments that have observed the United States using the dollar system as a financial weapon in ways that forced every other holder of dollar assets to reassess their exposure. The global monetary reset is the inevitable result of that reassessment. When the world's largest reserve asset issuer runs trillion-dollar deficits indefinitely, weaponizes the financial system through sanctions, and allows its domestic fiscal position to deteriorate to a point where long-term solvency becomes a legitimate concern, the world slowly begins to seek alternatives, at first gradually and then suddenly. We are currently in the gradual phase, but the shift into the sudden phase is much closer than most investors realize. Let me explain exactly what this reset looks like in practice, because this is not theoretical. It is unfolding in specific, measurable, and well-documented ways. At present, the first major dimension of this reset is central bank gold accumulation. In 2022, central banks worldwide purchased more gold than in any year since 1967. In 2023, they continued at nearly the same level. In 2024, the trend has persisted. Central banks in China, India, Russia, Turkey, Poland, and many other countries have been steadily increasing their gold reserves at a pace without modern precedent. Why is this happening? Because gold is the only reserve asset that carries no counterparty risk. It is not the liability of any government. It cannot be frozen by U.S. sanctions. It cannot be devalued by a central bank's money printing. It is the only asset entirely outside the dollar system that has preserved its purchasing power through every monetary crisis in history. When central banks accumulate gold at this pace, they are effectively signaling through their balance sheets what they believe about the future of the monetary system. They are indicating, in the clearest possible terms, that they expect the current dollar-centric system to be significantly less dominant in the future than it has been in the past. And they are positioning themselves accordingly years before that transition becomes obvious to ordinary investors. The second dimension of the reset is the creation of alternative payment systems. The SWIFT financial messaging system, which processes the majority of global cross-border financial transactions, has long been a key pillar of dollar dominance in global trade. Russia was cut off from SWIFT in 2022. China has been developing its own alternative, the Cross-Border Interbank Payment System, CIPS, for over a decade. India and Russia now settle bilateral trade in rupees and rubles. Saudi Arabia and China are testing yuan-denominated oil settlements. The infrastructure of a multipolar monetary system is being built right now, transaction by transaction, agreement by agreement, largely outside the awareness of most Western investors. The third dimension is the repricing of real assets relative to financial assets. In a dollar-dominant world where trust in the reserve currency is absolute, financial claims, stocks, bonds, cash, derivatives, carry enormous value because the system underwrites their worth. In a world where that trust is eroding, real assets, gold, energy, agricultural land, and physical commodities begin to gain value relative to financial claims because they retain worth independently of any government's promise. We are in the early stages of this repricing. Gold has already moved significantly. Energy-related assets have substantially outperformed financial assets over the past 3 years. The broader commodities complex has been signaling persistent inflation pressures that the Federal Reserve and mainstream financial media have consistently underestimated. These are not random market movements. They are the early stages of a fundamental repricing that reflects a shift from a world where financial claims are trusted without question to a world where real assets act as protection against the gradual erosion of that trust. Now let me explain what this means for you in practical terms. What you should own, what you should sell, and what actions you should take before this transition accelerates into something too fast for most unprepared investors to react to. The first and most urgent step is gold, physical gold, not gold ETFs, not gold mining stocks, not gold futures. Actual physical gold held directly or stored in allocated non-bank vault facilities. Personally, I hold 20% of my total investable assets in physical gold. That position is kept in allocated storage in Switzerland, outside U.S. jurisdiction, because if the scenario I am describing unfolds in its most extreme form, I want assets that cannot be frozen, cannot be subject to bail-ins, and cannot be controlled by emergency government actions during financial stress. The historical example of gold confiscation by the U.S. government, Executive Order 6102 in 1933, is not distant or irrelevant history. It is a documented precedent showing what governments may do when facing severe monetary stress and needing to control capital flows. Those who held gold outside U.S. jurisdiction in 1933 retained it. Those who held gold inside the United States were forced to surrender it at a government-mandated price. I am not predicting that 1933 will repeat. I am pointing out that correctly positioned assets are those that preserve their value regardless of what any single government decides under stress. The second action is reducing exposure to dollar-denominated financial assets that are priced for a world that is no longer the same. U.S. equities, particularly large-cap technology stocks, are currently trading at valuations that made sense in an era when the U.S. dollar's dominance was unquestioned, when interest rates were near zero, and when global capital had no alternative but to flow into American markets. All three of those conditions are changing at the same time. The dollar's reserve status is being challenged. Interest rates are structurally higher, and alternative investment destinations are expanding as emerging markets develop deeper capital systems. The valuation premium that U.S. equities have historically enjoyed over global markets was never purely based on earnings growth. It was partly a reserve currency premium, reflecting the reality that global investors needed dollar assets for reasons beyond return alone. As that reserve currency premium erodes, the valuation premium also compresses. The repricing of U.S. equities relative to global markets is one of the clearest investment themes of the coming decade, and it begins from current valuations that are already among the most stretched in modern financial history. The third action is exposure to energy and commodities. Oil majors, uranium producers, agricultural commodity companies, and copper miners fall into this category. These assets tend to outperform during periods of monetary transition for one very simple reason. Physical commodities are the only asset class that retains intrinsic value regardless of which monetary system governs global trade. Whether the world moves toward a gold-backed system, a multipolar currency basket system, a BRICS-style alternative reserve structure, or something that has not yet been defined, the world will still require oil. It will still require uranium for the nuclear expansion that is clearly underway. It will still require copper for electrification. It will still require agricultural commodities to feed a population of 8 billion people. These assets produce real cash flows from physical resources that cannot be printed by any central bank and cannot be devalued by any monetary policy experiment. In the context of a global monetary reset, they represent the most fundamental form of real wealth that exists. I currently hold 20% of my portfolio in this category, and I have no intention of reducing that exposure. In fact, if my 3 crisis signals are triggered, I will increase it further. The fourth action is holding direct government obligations outside the commercial banking system. Treasury bills purchased directly through treasurydirect.gov, not bank deposits, not money market funds through banks, but direct obligations of the U.S. government that completely bypass the commercial banking system. This serves 2 important purposes. First, it protects the cash portion of your portfolio from the banking system vulnerabilities I have previously explained in detail. Second, it generates a real yield of around 4.5% to 5% while you wait for the repricing that will create buying opportunities on the other side. Cash earning 5% during a period of monetary transition is not a sacrifice. It is optionality. It is the fuel that allows you to acquire high-quality assets at distressed prices when the transition accelerates. The greatest fortunes in investment history were never built by owning the right assets at market peaks. They were built by holding cash when everyone else was forced to sell. Now let me explain the 3 specific signals I am watching that will indicate when the transition moves from the slow phase into the fast phase. Because the difference between these 2 phases is the difference between orderly repositioning and emergency response. Signal 1 is the dollar index, DXY. The DXY, which measures the US dollar against a basket of major global currencies, is currently trading in a range that reflects relative stability. If the DXY breaks below a sustained new multi-year low, and the decline accelerates instead of stabilizing, that will signal that the gradual erosion of the dollar's reserve status is becoming visible in currency markets. Dollar weakness of that magnitude would simultaneously pressure U.S. Treasuries, reduce U.S. equity valuations in foreign currency terms, and accelerate global capital flows toward alternatives to the dollar. Watch the DXY closely. A sustained breakdown to new lows is signal 1. Signal 2 is the gold to U.S. Treasury ratio. Right now, gold is rising while U.S. Treasuries remain under pressure. If this relationship accelerates, if gold continues making new highs while long-duration Treasury bonds fall to new price lows, it will signal that global capital is moving away from the traditional safe haven of U.S. government debt toward an asset with no counterparty risk. This is one of the clearest real-time indicators of reserve currency stress. Watch the relationship between gold and long-duration Treasuries. Sustained gold strength combined with sustained Treasury weakness is signal 2. Signal 3 is central bank gold buying data from the World Gold Council. If central banks continue accumulating gold at or above the pace seen in 2022 and 2023, it confirms that global monetary authorities are continuing to vote against the dollar-centric system through their reserve allocation decisions. Central bank behavior is the most credible signal available because these institutions have access to information and analytical resources far beyond those of any private investor. When they accumulate gold at record levels for multiple consecutive years, they are not speculating. They are structurally repositioning based on their assessment of the future monetary order. If any 2 of these 3 signals persist simultaneously, it confirms that the transition from slow phase to fast phase is underway. At that point, the positioning becomes clear. Maximum exposure to gold, energy, and real assets. Minimal exposure to dollar-denominated financial claims at elevated valuations. And strong cash reserves ready to deploy into the extreme opportunities that systemic transitions always create for those positioned correctly. Now let me address the objection that I know is forming in your mind. This sounds like a prediction of dollar collapse. It sounds extreme. The dollar has been predicted to collapse many times before, and it never has. The United States remains the largest economy in the world. The dollar is still used in the vast majority of global trade. So why position for something that may never happen? Here is my answer, and I want you to consider it carefully. I am not predicting dollar collapse. I am predicting dollar transition. There is a critical difference between the two, and it has enormous implications for how you should think about positioning. Dollar collapse would mean a sudden and catastrophic loss of confidence occurring over days or weeks. That is an extreme tail risk scenario. I am not describing that. Dollar transition is a gradual, multi-year reduction in the dollar's share of global reserves, global trade settlement, and global financial transactions. That process is already measurable, documented, and underway. It has already been happening for over a decade. It is now accelerating. And even a partial transition, such as a reduction in the dollar's share of global reserves from 60% down to 40% over the next 10 years, would have deep and far-reaching effects on U.S. interest rates, equity valuations, and the real purchasing power of dollar-denominated assets. You do not need to believe in a full dollar collapse to accept that positioning for a dollar transition is rational. You only need to examine the data. Central banks are buying gold at the fastest pace since 1967. China has reduced its U.S. Treasury holdings by roughly 40% from its peak. Oil is increasingly being settled in currencies other than the U.S. dollar. And the infrastructure of a multipolar monetary system is actively being built by governments representing nearly half of the world's population. These are not forecasts. These are verified facts drawn from public sources such as the World Gold Council, the U.S. Treasury's TIC data, and the Bank for International Settlements. Anyone who chooses to look at the data can see exactly what I am seeing. The question is not whether this transition is happening. It already is. The question is whether you act on that reality before it accelerates to a point where orderly positioning is no longer possible. Let me end with something I believe more strongly now than at any other time in 40 years of observing financial systems. The global monetary reset currently underway is the largest structural shift in the world's financial architecture since President Nixon closed the gold window in 1971. It will not occur overnight, but it will unfold faster than most market participants currently expect. And the wealth created and destroyed during this transition will exceed anything seen in any financial crisis of my career. Those who are positioned correctly, those holding real assets, those who have reduced exposure to overvalued dollar-denominated financial claims, those who own gold, energy, and maintain cash ready for deployment, will build wealth in this period that can benefit their families for generations. Those who remain fully invested in traditional U.S. equity and bond portfolios at current valuations, who are relying on advisors telling them to stay the course because the United States always recovers, and who are not observing what central banks are actually doing with their balance sheets, are taking risks they do not fully understand. I have positioned myself for this transition. Carefully, deliberately, and with full awareness that timing any macroeconomic shift is never exact. I may be early. I have been early before. But being early only costs temporary underperformance. Being wrong in the opposite direction during a monetary regime shift costs permanent loss of purchasing power, because currencies that lose reserve status do not recover it. History shows no example of a reserve currency that declined and later regained its former dominance. The British pound lost its reserve currency status in the 1940s and 1950s, and it never returned to its previous role. That asymmetry between outcomes is what drives my positioning, and it should inform yours. The global monetary reset has already begun. The evidence is in the data. The signal is in central bank behavior. The direction is clear to anyone willing to look at reality rather than assume the continuation of past narratives. Act now, not because anyone can predict the next 12 months with certainty, because nobody can, but because preparation must happen before acceleration begins. The assets you want to own during a monetary reset are already moving. Gold is already making new highs. Energy assets are already outperforming. The window to accumulate at reasonable prices is already narrowing. Build your exposure to gold. Build your exposure to real assets. Keep cash outside the banking system. Reduce exposure to financial claims priced for a world of permanent dollar dominance. because that is no longer the world we live in. The reset is underway. The opportunity is real. The window is open. Act now before it closes.